let's begin with the broader expectations when it comes to the banking sector as far as Q2 earnings are concerned.
Yes, so I think clearly there will be pressure as far as earnings are concerned. For PSUs, it will be a quarter, another subdued quarter, and we are expecting a meaningful decline in their YOY profits, almost 20% YOY drop in our coverage universe. For privates also, we are seeing moderation as far as earnings is concerned. So until last quarter, we were running at 27% YOY for our coverage universe. That number should be closer to 14%, slightly higher than that from a YOY standpoint as far as privates are concerned. And clearly, there are pressures on the top line to an extent exaggerated by the fact that treasury profits could be missing during the quarter, and revenue progression could also be low on account of the fact that NII growth might not be very high. So that's broadly what we expect. Provision should remain at elevated levels because asset quality issues are far from over. So our sense is that provisioning requirements will remain high for PSU banks. For privates, it might not be as pronounced as it is for PSU banks, and hence a sharp decline in PSU banks' profitability. While for privates, as I said, we're looking at 14–15% kind of a growth.
That you mentioned that as far as asset quality concerns are they're far from over. Does that mean that for most of these banks, the pain is actually going to increase in a couple of quarters from here on?
I think that for corporate lenders, we are likely to see some pain. We've seen GDP growth, the kind of numbers that we saw. So our sense is that this could mean that clearly asset quality pressures will remain at elevated levels. Our interactions with the banks when we were met a whole lot of banks in the last couple of weeks also makes us believe that there's little respite on the asset quality front. So most banks, we believe, are likely to report similar kind of slippages as Q1, and Q1 was a very high number. From a restructuring standpoint also, I think we are likely to witness a similar trend. So asset quality issues likely to persist, and clearly that will be the key thing to watch for. From a margin standpoint, we are we're getting mixed views. So we're looking at flattish margins. For some banks, there could be an uptick, but flattish to some decline as far as margins are concerned. We do not see a meaningful fall in margins except for some banks which got impacted on account of the MSF rates which were up during the quarter.
Shell tells me that when it comes to IndusInd Bank, like most of the industry, there will be some decline in NIMs, but the loan growth can be better than what the industry is looking at. What are the key factors that you are watching out for IndusInd Bank?
I think IndusInd Bank, really what we're watching out for is what happens on the margins front, because as I mentioned to you, the MSF rates being up, anybody who's wholesale funded could get impacted on account of that. What is also interesting is the guidance they give at the margin as far as net interest margins are concerned, because at the shorter end of the yield curve, rates have come off again. So we were earlier starting with a margin compression of 20 odd basis points plus on a full year basis. Are we likely to see that kind of a number, or it could be probably lower? That's a key thing to watch for.
When it comes to credit growth, are you also expecting an improvement, and to what extent can we see that happening then?
I think credit growth, if you were to look at for the entire industry, we're running pretty good at high teens, because after the MSF rates were hiked by 300 basis points, we did see corporates borrow short-term from the credit market as opposed to CPs and bond market. So credit growth has been good. Our sense is that as we going forward, credit growth, which is currently at 18% levels, will start looking down from here on.
Right,
but clearly, if you were to ask us from a trend standpoint, our sense is that privates will grow faster as far as credit growth is concerned.